What if everything you've been told about investing is wrong? What if the smartest investment strategy on earth requires you to do almost nothing? No stock picking. No staring at charts. No watching the news every night to see if your money is safe. What if I told you that millions of investors spend their entire lives trying to beat the stock market, studying charts, listening to experts, jumping from fund to fund, and most of them still lose to a strategy that takes less than 5 minutes a year to follow? It sounds impossible. It sounds almost insulting. How can doing less beat people who try harder? But here's the strange part. This isn't a theory, it isn't a guess, it is one of the most tested, most proven ideas in the entire history of money. And the man who discovered it wasn't trying to get rich from a clever trick. He was trying to fix something that he believed was deeply unfair to ordinary people. By the end of this video, you will understand why so many smart, hardworking people lose money in the market without even realizing it. You will understand the one decision that matters more than almost any other decision in investing. And you will understand why a former janitor with no special skills and no college degree can sometimes retire wealthier than a doctor with a 6-figure salary. Stick with me, this is going to change how you think about money. Let's go back to the 1970s. There was a young man named John Bogle. He wasn't flashy. He didn't look like the Wall Street men you see in movies, the ones with shiny suits and loud voices shouting about hot stocks. He was quiet, serious, and a little bit stubborn. Bogle had spent years working inside the investment industry. He saw something that disturbed him deeply. He saw that the people running mutual funds were charging enormous fees. He saw that fund managers were trading constantly, generating costs that quietly drained investors' savings. And he saw that despite all this effort, all this trading, all this expensive expertise, most of these professionally managed funds were not even beating a simple, boring measurement of the stock market as a whole. Most people don't realize this. The very people we trust to grow our money are, on average, underperforming the market itself. Not because they are lazy. Not because they are stupid. Many of them are brilliant. But because of one mathematical truth that almost nobody talks about, and we are going to reveal it to you very soon. Bogle had an idea. A radical idea. What if, instead of paying smart people huge amounts of money to try to beat the market, you simply bought the entire market itself? Every company, large and small. Winners and losers. All of it in one single basket. People laughed at him. Competitors called his idea un-American. They said it was a strategy for people who didn't want to try. They said it guaranteed mediocrity. But here's where it gets interesting. Bogle wasn't trying to be average. He was trying to be smarter than everyone chasing greatness. Because he understood something that most people, even highly educated people, completely miss. Let's slow down and make this simple enough for anyone to understand, even if you have never invested a single dollar in your life. Imagine a giant pizza. This pizza represents the entire stock market. Every slice represents a company. Some slices are bigger, like the biggest companies in the world. Some slices are smaller, like newer or smaller businesses. Now imagine a room full of professional chefs, all competing to pick the best slices before anyone else. They study the pizza for hours. They argue about which slice will taste better next year. They charge you money for their expert opinion on which slice to pick. But here's the twist nobody tells you. All of these chefs combined are eating from the same pizza. If one chef gets a bigger slice, another chef gets a smaller one. On average, across all of them, they can only ever eat the whole pizza. They cannot create more pizza than actually exists. This is the secret at the heart of investing. The stock market as a whole grows at a certain rate every year, based on how the real economy grows, how companies earn profits, and how those profits get reflected in stock prices over time. That growth is the entire pizza. Every single investor in the world is sharing slices of that same pizza. Some win more, some win less, but together, before costs, everyone earns the same average return as the market itself. It's mathematically guaranteed. It has to be true, the same way it's mathematically true that not every student in a class can score above the class average. So here's the real question. If trying to pick winning slices doesn't create more pizza, what actually decides who ends up with more food on their plate at the end of the night? The answer is the size of the bill the chefs charge you. This single idea may completely change how you think about money. Every time you pay a management fee, a trading cost, a commission, an advisory fee, you are taking a slice of pizza off your own plate before you even get to eat. And here is the part that shocks most beginners. These costs sound small. 1% here, 2% there. It sounds harmless, almost too small to matter. But money doesn't grow in a straight line. It grows by compounding, meaning your gains start earning their own gains year after year, like a snowball rolling downhill and getting bigger and bigger. And when you take a small slice away every single year, for 30 or 40 years, that tiny slice becomes monstrous by the end. Imagine two friends. Both invest the same amount of money. Both earn the same return from the market before costs. The only difference is that one of them pays high yearly fees to a managed fund, while the other pays almost nothing by simply owning the entire market through a low-cost index fund. After 30 or 40 years, the friend who paid lower costs could end up with dramatically more money, sometimes enough to retire years earlier, simply because they let compounding work without feeding the meter every single year. Same starting amount, same market, same amount of risk taken in the broad market. Completely different outcome. Not because one friend was smarter about picking stocks, but because one friend understood the silent, invisible cost of fees, and the other one didn't. This is the chapter most people skip in their financial education, and it might be the most important one of all. Now here's where most investors make their next big mistake, and it has almost nothing to do with math. It has to do with emotions. Imagine the stock market as a roller coaster. It goes up, it goes down. Some days are thrilling, some days are terrifying. Most people believe that the secret to investing is finding the perfect moment to jump on the roller coaster and the perfect moment to jump off before it drops. However, there was a hidden problem with this idea. Nobody, not even professional fund managers with decades of experience and powerful computers, can reliably predict the short-term ups and downs of the market. Study after study has shown that investors who try to jump in and out, chasing hot trends and avoiding scary headlines, tend to perform worse than investors who simply stay on the ride from beginning to end. But because the market's biggest gains often happen suddenly, in short, unpredictable bursts, often right after the scariest moments. If you panic and jump off the roller coaster during a crash, you might miss the exact days when the ride shoots back upward. And missing just a handful of those powerful days over a lifetime of investing can quietly destroy decades of potential growth. Most people don't realize this. The danger isn't the market falling. The danger is your own reaction to the market falling. This is one of the deepest lessons hidden inside Bogle's philosophy. Investing success isn't mainly about intelligence. It's about temperament. It's about discipline. It's about being boring on purpose, year after year, while everyone around you is reacting emotionally to news headlines designed to grab your attention. Think about it like planting a tree. You don't dig it up every few months to check if the roots are growing properly. You water it, you give it time, and you trust the natural process. Pulling it out of the ground constantly to inspect it doesn't make it grow faster. It only damages it. Your investments work the same way. The biggest threat to your wealth might not be a market crash. It might be your own hand, reaching in too often, moving things around, reacting to fear and excitement instead of letting time do the quiet, powerful work it was always meant to do. Now let's talk about something that sounds boring on the surface, but is actually one of the most liberating ideas in this entire book. Most people believe that successful investing requires special talent. They believe you need to be naturally gifted at reading financial statements, predicting economic trends, or sensing which industries are about to boom. This belief stops millions of people from ever starting because they assume investing is only for experts. But here's where it gets interesting. Bogle's entire message flips this idea upside down. He argued that trying to be clever is often the very thing that hurts ordinary investors the most. The constant urge to do something, to adjust, to chase performance, to switch funds after a bad year, to buy whatever investment is currently popular. This constant activity creates costs, mistakes, and missed opportunities. Simplicity, done consistently, beats complexity, done emotionally. This is one of the most repeated lessons throughout the book, in different forms, again and again. Imagine you are growing a garden. One gardener changes the entire layout every single month, ripping out plants that haven't bloomed fast enough and replacing them with whatever looks exciting in a magazine that week. Another gardener simply plants a wide variety of seeds across the whole garden, waters consistently, and lets nature run its course for years. Which garden do you think looks healthier after 20 years? This is the essence of owning the entire market instead of guessing which individual pieces will bloom. You don't need to know which company will be the next great winner. You simply need to own all of them, so that whichever companies do succeed, and history shows that some always do, your portfolio automatically captures that growth without you having to predict anything in advance. At this point, you might be thinking, this all sounds nice in theory, but does it actually work in real life with real people over real decades? And the answer, based on decades of data across different time periods, different market conditions, and different countries, consistently points in the same direction. Low-cost, broadly diversified investing, held patiently over long periods of time, has outperformed the majority of professionally managed funds that try to beat the market through active trading and stock selection. This isn't a one-time coincidence. This isn't luck. This is closer to a law of mathematics wearing the costume of an investment strategy. So why doesn't everyone do this? If the answer is this simple, why are so many people still falling into the same traps? Here is the uncomfortable truth. Simplicity doesn't sell, excitement sells, predictions sell, hot tips sell. Nobody gets famous on television by saying, just buy the whole market and wait calmly for 30 years. That message doesn't generate clicks or excitement. So the financial industry, the media, the constant noise of headlines, all of it profits more from convincing you that complexity is necessary, even when the data quietly says otherwise. This single realization might be one of the most important moments in your entire financial life. The system isn't always designed to help you make the best decision. Sometimes, you have to deliberately tune out the noise to make the smartest possible choice. Now let's talk about risk, because this is something beginners often misunderstand completely. Risk doesn't mean the market goes up and down. That's not risk, that's just normal behavior, the same way weather changes from sunny to rainy throughout the year. Real risk is making decisions that permanently damage your financial future, like panic selling during a downturn, putting all your money into a single risky bet, or paying so much in fees that even a winning investment quietly turns into a losing one over time. Diversification, meaning spreading your money across many different companies and industries instead of betting everything on one, is one of the simplest tools for reducing real risk. When you own a small piece of thousands of companies instead of betting everything on a handful of stocks you personally picked, you protect yourself from the disaster of any single company failing completely. Think of it like this. If you have one umbrella and it breaks during a storm, you get completely soaked. But if you have 100 small umbrellas spread out, and a few of them break, you're still mostly protected. Some individual companies will fail. Some will even disappear completely. But the market as a whole, made up of thousands of companies across history, has consistently grown over the long run, even after wars, recessions, and crashes that felt like the end of the world at the time. This is why owning the entire market, rather than trying to handpick individual winners, isn't a lazy strategy. It's a deeply rational one, grounded in protecting yourself from the unpredictable nature of any single company's future. Let's talk about something deeply human now, something that goes beyond charts and numbers. There's a strange kind of pride that comes from picking a stock yourself, watching it rise, and telling your friends about your genius decision. There's almost no excitement in saying, I bought a fund that simply tracks the whole market and I haven't touched it in 15 years. It doesn't feel impressive at a dinner party. But here's the deeper truth hiding underneath that social pressure. Investing isn't a performance for other people. It isn't a competition to look smart in conversation. It is a long, quiet process of building real financial security for your future self, your family, and the freedom to make life choices without being trapped by money stress. The investors who succeed the most over decades are rarely the ones bragging the loudest in the short term. They are often the calm, consistent ones who treat investing the way they treat brushing their teeth, a simple, unglamorous habit, repeated faithfully, that quietly protects something precious over a very long time. And what happened next changed everything for an entire generation of ordinary investors. As this philosophy spread, more and more people gained access to extremely low-cost ways of investing in the total market, something that used to be difficult and expensive for regular people to do. Teachers, nurses, mechanics, small business owners, people who never had access to expensive financial advisors, suddenly had a realistic path toward building real long-term wealth, simply by being patient and consistent. This is what made this philosophy so much bigger than just a clever investment trick. It became, in a quiet but powerful way, a tool for financial fairness, giving ordinary people access to the same long-term growth that was previously dominated by wealthy clients who could afford expensive professional management. So let's bring this all together now, because every idea we've covered points toward the same final lesson. You don't need to predict the future to build wealth. You don't need to be a genius. You don't need insider information, expensive advisors, or hours spent watching financial news every single day. What you actually need is patience, discipline, low costs, broad diversification, and enough emotional control to stay invested through the scary years as well as the exciting ones. This single idea may completely change how you think about money. The goal was never to beat everyone else in a flashy, exciting way. The goal was always to capture the steady, reliable growth of the economy itself, letting time and compounding do the heavy lifting, while you simply get out of your own way. If you take only one lesson from everything we've discussed today, let it be this. The biggest threat to your financial future usually isn't the market. It's the unnecessary complexity, the unnecessary costs, and the unnecessary emotional decisions that get added on top of a process that was actually designed to be simple all along. Stop trying to outsmart the market every single day. Start letting the market work quietly for you year after year, the same way a tree grows stronger every season without anyone needing to dig it up to check on it. Because in the end, the most powerful investment strategy in the world might not be the one that sounds the most exciting. It might be the one that requires the most patience. And now you know it.